What I'll show you actually is so this is a graph showing the time trend for the fraction of the two groups who are on welfare in each of in each month over the first 18 months from when they're assigned. Okay, so the solid line you see is the welfare participation rate for the control group. Okay, and then the dashed line is the participation rate for the program group who received the SSP offer. And the difference between those two is you can think of as being the treatment effect, or the effect of the subsidy offer, encouraging people to leave welfare. Okay. And actually, when the first study was done after 18 months, there was a lot of excitement around Canadian, both policy circles and also in the researchers, because this was considered quite a large impact. Actually, is on the order of about twice the size of impacts from comparable sort of so-called work demonstration projects done in North America. So there's quite a lot of excitement that this may really work. And in terms of the magnitude of the effect, so there's the maximum impact is around about 15%, I think, 14% after 15 months. And alternatively, you could think of over that period, around about 20% of the control group had left welfare and taken full-time work. Well, you get similar effects if you look at the employment rates, actually. And for the program group, around about 33% had left. So the relative effect was sort of on the order of 2/3 over and above the. So it's quite a large impact. Now, if you look at the long term, so you can see the big impact is really over the first 15 to 18 months, and then it sort of gradually tapered off. So the explanation really for that is associated with the time limits that were associated with essentially either use it or lose it. If you didn't use it over the first 12 months, then you lost your entitlement. So what the subsidy did was to encourage, accelerated the departure from welfare and into full-time work, and eventually tapered off. So coincidentally, by the end of the period that we had full data, the impact was zero. Okay. So that was for the long-term stock, the recipient study. A similar long-term graph for the applicant study shows that profile, and the first 12 months is really the effect of, if you like, the period in which they had to stay on welfare if they want to become eligible. So the effect of that delayed exit incentive was around about 3 percentage points, or around about 6.5% of those who, in the control group, who would have stayed on naturally. An extra 3 percentage points, or 6.5%, stayed on in the program group. And then you get a similar profile after the initial 12-month period. It turns out for the applicants study, the relative impact is somewhat larger. So I'll show you this gives a summary of the impact. So the first column there is for the recipients, and the second column is for the applicant study. So the relative impacts for the applicants are somewhat larger. Okay. Our interpretation of that is probably that the applicants, because they were consisted of new applicants to welfare, had typically better human capital and better work skills than the long-term stock. So even though some fraction would become long-term, on average they were less disadvantaged, and we believe that was primarily the reason for the greater impact. The main difference actually that we could find from our studies between the responses of the recipients study and the applicant study was that by and large the participation patterns were pretty similar, both in terms of welfare and also in terms of employment. The main difference actually was in terms of the wages received by the recipients and applicants. And from our assessment of that, it looked like the incentives for the recipients was to, in economic speak, to lower the reservation wage and take a lower paying job. So that the average wage that we estimate associated with those who responded to the incentives was around about minimum wage levels. So the examples I gave at the beginning, that it more or less doubled their earnings taking a minimum wage job. The downside to that is that there probably wasn't much in the way of skills development or human capital development associated with those jobs, which probably contributed to the relatively small long-term impacts. In contrast, the applicants who responded to the incentives seem to be responding by increasing their job search effort. So their wages actually were pretty representative on average, compared to, if you like, the average wage of the control group folk who are working. And again, I think the difference is the better human capital, work skills and job opportunities associated with the new applicants versus the long-term stock. The impacts were a little bit larger and persisted a bit longer for the applicant study as well. But as you can sort of see, the long-term impact is at least in terms of differences in employment rates or differences in welfare participation rates were died out eventually. We haven't done it, but there's some analysis done in terms of cost-benefit of the studies, and from what I've read of that, they seem to be reasonably positive, but I confess I'm a bit sceptical of that because there's a pretty large, what economists would call deadweight loss associated with this program, because the supplement was going to all members of the program group who took full-time work during the first year. And a lot of those, you could see from the control group comparison, would have taken full-time work regardless of the subsidy. Okay, so, but nonetheless, the estimates I've seen suggest that it did have quite reasonable cost-benefit properties. Anyway, again, I'm sorry, I'm not a singer, so I have no song to go with this to wrap up. But so I'm, in terms of punchline, I'm not sure if it's positive or negative, but I guess as a cautionary note, I'd say, well, there is responsiveness to the earnings incentives, but whether they last long term beyond the expiry, it's hard to know really, and that's a more difficult question to answer. Anyway, thank you.